Now let's assume we have a new project. The project is an equipment replacement. The new equipment will cost $3.8 million. It will be depreciated on a straight-line basis over 5 years to a zero salvage value. The old equipment will be sold for its book value of $300,000. The old equipment has 3 years of straight-line depreciation remaining. The new sales associated with the equipment will be $10 million for 5 years. However, the project will cannibalize $1 million in sales from another plant. The cost structure will be the same as the firm as a whole. Net working capital is still 6% of sales. At the end of the project, net working capital will be recaptured, and the sale of the asset will be zero. We'll assume a weighted average cost of capital of 10.5%. Now we see the free cash flows for the firm with the new project. Overall, sales have increased by $9 million. This includes the $10 million in new sales for the new project, but also reflects the loss of $1 million in sales in another plant. Cost of goods sold is 78% of sales, and SG&A is 10%. Depreciation with the new projects incorporates the old depreciation plus the depreciation on the new equipment. We also have to deduct out the depreciation on the old machine, which has been sold. This depreciation needs to be deducted because it is a benefit, a tax shield, which is not there anymore because the asset was sold. Now we have the new EBIT, and next we deduct taxes to get NOPAT. The next step is to add back depreciation, then deduct capital expenditures. Here we start with the old capital expenditures, add the capital expenditure of $3.8 million for the new asset in the now column. Next we account for the sale of the old asset at $300,000. Note, since it's sold at book value, there are no tax effects. The sum of these gives us the capital expenditures for each year. The final item is net working capital. Once again, we start with the old net working capital. In the now column, we need to add the net working capital needed to support the $9 million net increase in sales. The net working capital is 6% of $9 million, or 0.54. Since net new sales remain constant, there's no further increase in net working capital. In year 5, the project ends and we recapture the 0.54 in net working capital for the $9 million in new sales. The bottom line is the total free cash flow for the firm with the new project. Now we can estimate the incremental free cash flows for the project. We start with the free cash flows for the firm with the project and then deduct out the free cash flows for the firm without the project. The difference is the incremental free cash flows attributable to the project. The initial investment is $4.04 million, and we have the incremental free cash flows for the next 5 years. If we discount the free cash flows at the weighted average cost of capital of 10.5% and deduct out the initial investment, the NPV of this project is a negative $120,000. Since the NPV is negative, this project should be rejected. Now, most of the time we will not go through the process of estimating the free cash flows for the whole firm with or without a project. It tends to be a very cumbersome process. As such, the more typical approach is to examine each item on an incremental basis. In order to do this, we need to think about how each item changes because of the new project. The incremental change in sales is the $10 million less the $1 million in lost sales at the other plant. Cost of goods sold is still 78% of sales, and SG&A is 10%. The change in depreciation is the sum of the depreciation on the new asset for 5 years, less the lost 3 years of depreciation on the old asset. Now that we have the change in EBIT, we can calculate the change in taxes and get the change in NOPAT. Next, we add back the change in depreciation and deduct the changes in capital expenditures. Once again, we start with the capital expenditure for the new asset and adjust for the sale of the old asset. Next, we take care of the change in net working capital. In this case, we're lucky. The only net change is the incremental investment of net working capital for the $9 million in new sales. However, sometimes it's necessary to go through the process of calculating the change in net working capital for the firm without the project, then calculate the change in net working capital with the new project to accurately estimate the change in net working capital. The key is that we need the incremental change in investment in net working capital. Note that we've added the recapture of the change in net working capital in year 5. The sum of all of this is the change in free cash flow associated with the new project. It is the same as the change in free cash flow that we calculated above. Remember that incorporating all the changes on an item-by-item basis can be tricky. When in doubt, you should go back to the basic idea. The incremental free cash flow is the difference in the free cash flow for the whole firm with and without the project. Capital budgeting is one of the most important activities that a firm engages in. The new investments that a firm makes are the clearest statement of its strategic intent. Hence, the process it uses to evaluate investment choices is critical. Most firms use a net present value approach to evaluate investments. The way firms choose to implement the NPV analysis generally reflects the fact that organizations tend to be separated along functional lines. There's a separation between operational functions and the finance function. In addition, projects tend to be financed from a pool of funds, which makes it easy to separate the operations financing for a project. As such, firms use free cash flows and weighted average cost of capital to calculate the NPV of projects. Free cash flows reflect only operations, and weighted average cost of capital reflects the financing. One of the key ideas here is that we should use incremental free cash flows to evaluate projects. Incremental in this case means the change in free cash flows for the whole firm due to the project. Careful and consistent application of these principles will allow a firm to choose projects that create value.